Cyclical Asset Returns in the Consumption and Investment Goods Sector by Burkhard Heer, Alfred Maussner and Bernd Suessmuth, published in the Review of Economic Dynamics 2018. Hello and welcome to our presentation here of the main results from our Review of Economic Dynamics article. In this paper, we looked at the production-based capital asset pricing model. And we study stock returns, the equity premium, the Sharpe ratio, the predictability of stock returns. So our results are important to researchers, of course, in the field of finance, macroeconomics, to uninterested undergraduates or graduate students in the field of economics and finance, but also to people working in the investment banking industry with Morgan Stanley, with Goldman Sachs, who are sitting in the research departments and trying to analyze behavior of stock markets. Now, this research is carried out with two colleagues of mine, Alfred Maussner from the University of Augsburg and Bernd Suessmuth of the University of Leipzig. Our starting point are the stock price indices in the different sectors, the consumption goods sector, which is the blue line, and the red line, which is the capital goods industry, and their behavior over time. So please do not interpret levels. This is just normalization, 1000 here for the consumption goods and 100 for the two different industries here. But what we look at are two different industries, and that's the new feature of our paper. So most papers, actually all papers that I know of, they just study the aggregate economy, look at the aggregate stock price level, for example, the Standard & Poor's 500, but what they do not analyze are industries or sector stock returns. And of course, this is interesting for, let's say, a portfolio manager who would like to know, should I rather invest in the consumption goods sector, in the investment goods sector? Should I rather buy, let's say, Google or Alphabet or Amazon, or which kind of stock should I pick? And this two-sector model can easily be extended to a multi-sector model and is, of course, of great use for both the researcher and also to the banker. Now let's study the behavior of these two time series. And as you can see, they behave differently. So consumption goods and investment goods, they are two different kinds of goods. So for example, the consumption goods stock prices, which we constructed ourselves here, peaks prior to the investment goods stock prices. So it peaks in the year 1998, and the investment goods sector peaks in the year 2000. And then we have the dot-com crash in the stock markets, and both fall until the years 2003. So the crash in the investment goods stock prices occurred at a later point of time. And if you look how long it took the two sectors to the stock prices to recover, well, for the capital goods, it took them from the year 2000 until the year 2007, 7 years to recover to the prior maximum. And in the consumption goods sector, well, it didn't recover to the old level over the whole period that we studied. So the last period that we looked at is period 2012 here in this diagram. So we noticed they behave differently. And we study these different behavior in our model and try to explain this kind of behavior. Now, let me also point out another prominent crash here, which is the Great Recession, which took place in 2007, 2008, and the stock markets here behaved similar in the consumption goods and in the investment goods sector here. And we had, well, the bottom here is in 2009, and here the consumption goods stock prices recovered within 3 to 4 years, while the one in the capital goods sector, they hadn't recovered by 2012 in our data. Now let me show you what we think is driving these results. Here we look at the total factor productivity in these two sectors. So the investment, we normalized it to 1 in the year 1980, and as you can see, well, productivity in the consumption goods sector is hardly increasing and rather flat over the next 30 years. And in the investment goods sector, we have an increase in the productivity. So sector-specific or even industry or firm-specific productivity, well, we will identify it as one of the driving sources how we can pick stocks, find stocks or sector prices here that perform better than others or perform worse than others. And as you can see in the investment goods sector, we had a large increase in the total factor productivity. Well, of course, there's a simple explanation for it. Well, if you look at some consumption goods like services or restaurants, a haircut or a meal, well, the productivity does not increase by much. You take some 20 minutes, 30 minutes for a haircut today or 20 years or 30 years ago. But when you look at the productivity in the investment goods sector, look, for example, at robots, their use became more and more efficient and is characterized by higher productivity over time. Similarly, computers, artificial intelligence, stuff like this. And these two different dynamics here will help to explain the different stock price behavior that we observe empirically in the United States. Now let me show you the main idea of the production-based capital asset pricing model. I showed to you for the one sector model and tell you what's necessary so that we can extend it to two sectors or multi-sector economy. We start from the observation that consumption, income, output fluctuate over time. Here it's a little simplified, so with a constant duration of a business cycle here from boom to boom or from recession to recession. That's not the case empirically, so we have some shorter booms, some longer booms. For example, Australia just experienced a boom of almost 20 years. So in research, we think there's no fixed duration of a business cycle, but for illustrative purposes here, I use this assumption. Similarly, I simplify with respect to the risk-free rate here, which is usually taken to be the real treasury bill rate in the United States. So the treasury bill rate minus inflation, and inflation is estimated in our case by a consumption deflator. And let's assume it's constant, it fluctuates a little, but in comparison to the equity returns, it's quite constant. So the equity returns, they fluctuate more by a factor of 18 if you look at the standard deviations in our data here. And what we also observed that the stock returns are uncorrelated to the business cycle. So we might have some, for example, recessions where we have high stock returns and some recessions where we have low stock returns. So the correlation is close to zero. It's insignificant. So insignificantly different from zero. Now, as a household, how would you like your consumption to behave? Well, you are risk averse. You do not like times where you have a good life. Let's say you live in a chateau, and the next life you live on the street because you have no income. You would rather have something like some smoothing of your consumption. So live in a decent apartment all the time rather than be homeless half of the time and live a luxury life the other half. So we do not like these fluctuations. And this kind of behavior is usually captured by our intertemporal elasticity of substitution, our IES, which tells you by how much we dislike this to have periods of high and low consumption, rather have a smooth consumption profile. Also, if we have built up habits, like, for example, that we got used to something like living in a nice apartment or have a nice car or something like this, well, if we then lose our car or apartment, we have much bigger loss of utility of welfare than if we are not used to these kinds of nice treats here. Okay, so what will the household do in times of low consumption? Well, he is selling his stocks or his treasury bills. Now with treasury bills, let's say you can always get up to this point here, not completely recover to the average consumption, but a good way. And if we is selling stock, let's say in period T0 in this recession, well, there we have high returns on the stock prices. It will get him up to here. And here we have low returns, so the household will only be able to afford consumption here. So what you notice, well, with the help of risk-free rate, with the treasury bill, you can get much smoother consumption here than in the case of stock markets, where you use the stock market to smooth your consumption. So, and for this kind of remaining risk, of this volatility of consumption that remains when you hold either stocks or risk-free rate, the treasury bill, you demand a risk premium on stocks, the so-called equity premium. And I have not drawn this here correctly, so here the average return of the risk-free rate is exactly the one of the equity return. Well, therefore, people demand a higher return of stocks than of the risk-free rate of treasury bills on average. That's the equity return. And historically, this equity return, a famous paper by Mara Prescott, there's 6%. Now it has probably gone down to less than 6% because of the advances in computer technology, financial technology, fintechs, whatever. So today, if you just have 100 euros each month to invest, well, you can invest in the stock market because of exchange traded funds, little provision to buy the stocks, hold the stocks. This was different 30, 40 years ago, where there was huge costs of holding stocks, and therefore our equity premium has gone down over time because it's less costly to hold stocks, and you do ask a smaller risk premium nowadays. So that's mostly behind the secular decline in the equity premium. Now, in order to replicate this equity premium in a production-based asset price model, in the production-based capital asset price model, we need to include some certain elements. As I've already mentioned, we need to have risk-averse households with an intertemporal elasticity of substitution, which reflects some reluctance to shift consumption over time, and habits. This will be both part of our model. Now, if you also introduce labor here in this model so that people can work more or less depending on whether they would like to afford more or less consumption, well, you also have to somehow restrict how people can intertemporally substitute labor. And this is usually done with sticky wages or with adjustment habits in labor. And we introduce sticky wages. And a third basic element in this model is the equity premium, or the risk return, the return of capital. Now, you know from your microeconomics class or macroeconomics class, if we have something like a production function like this, like a Cobb-Douglas production function in capital and labor, and we have depreciation rate of delta, well, then our return here is equal to the marginal product of capital minus delta. And if we introduce productivity, well, then we have this factor Z in here. That's what the business cycle literature, the real business cycle literature does. Now, if we want to get risky return, fluctuations in the return, we need fluctuation in the marginal product here and the depreciation rate to somehow match our empirical time series. Now, when we look at the capital stock, it hardly fluctuates at all. Why? Because if investment in a firm goes up or down, well, quarterly investment is something like 2 or 3% of the capital stock. Well, therefore, if we stop investing in the capital stock, well, total capital is hardly affected. So we get little effect of little or high investment on the capital stock in our economy or in a sector. So this fluctuates little. We find that the productivity level here fluctuates by 1 or 2%. So what we get here is that our return on capital just fluctuates by 2, 3% or 4%. And of course, we would like to have much higher volatility of this return here in order to replicate the volatile stock returns. This is a production side of the model, which comes in here, the production-based capital asset price model. Some of you might know the consumption capital asset pricing model, CAPM. There, the process here of the return on equity and the risk-free rate is taken as exogenous. In the production-based model, we go one step ahead and endogenize these two interest rates here. Now, when we study the production-based CAPM, we would also like to get more volatility in the stock returns. And in order to get this, we need a variable price of the capital stock. And this is done by introducing adjustment cost of capital. So if we have adjustment cost of capital, well, it's easy to change the capital stock a little, but if you want to change it by much, well, then you have higher and higher cost. Or if you want to sell it because you're in a recession, well, prices for the capital stock plummet and you cannot get rid of your machines. And in order to capture this empirical observation, we introduce adjustment cost of capital in our model, and therefore we get also a price effect, the price of capital in our equity return, and this will allow us to have volatile returns as volatile as in the US economy. Now let me show you the results from our analysis here. So we replicated that the equity premium on the consumption goods sector is 3% in our model. And we also replicate that in the investment goods sector, the equity premium, the annual is higher than in the consumption goods sector. But you see, that's we replicated qualitatively, but quantitatively we fall short here. We replicate the fact that the Sharpe ratio in the consumption goods sector is lower than in the investment goods sector. So the Sharpe ratio is defined as the equity premium over the standard deviation of the stock returns. And the equity premium is defined as the stock return minus the risk-free rate. So our stock returns in the two sectors minus the treasury bill rate, the real rate. Now our model does much better even in replicating the following three observations. We replicate the cross-correlation structure between asset returns and aggregate output, or to be more specific, the growth rate of aggregate output. We also replicate some forecasting abilities of log dividends ratio. So empirically, with log price dividends ratio, you can predict stock returns. And we show that you can do this empirically in the two sectors and also in our model. And we also show that both empirically and in our model, the risk-free rate is not predictable. Now you find this material, the material to our paper in the internet. So let me show you some of these pages. So the article can be downloaded from the Review of Economic Dynamics. Unfortunately, it's not open access yet, so you need to have access to the Elsevier. So it's Cyclical Asset Returns in the Consumption and Investment Goods Sector by Heer Maussner Suessmuth and me. There is a preprint version available. So for this reason, please visit my homepage. You find the address here in the first line. And just scroll down, and here you find the preprint. You can download the PDF. If you do have problems finding my homepage well and downloading this PDF, just send me an email and I will send you the paper. So my email is burkhard.heer@wiwi.uni-augsburg.de. And you also find code and data in the internet. So the Fortran and Stata code here can be found on this ideas repack page, code and data files for cyclical asset returns in the consumption investment goods sector. Here's the address, and it's Fortran and Stata basically. And if you would like to start with an easier example, so for example, the one sector aggregate model and its computation, well, you find this in our book. So a book by Heer Maussner and myself, Dynamic General Equilibrium Modeling, Computational Methods and Application. Here you have the homepage of this book and you find the code. This is the book, Dynamic General Equilibrium Modeling, and you find Gauss, MATLAB, Python and Fortran routines for this book on our homepage for our second edition here, and can download it. For example, the code for the production CAPM, the one sector production CAPM, is available in Gauss and Fortran, and you can download it here from our homepage. In the remaining 15 minutes, I will present to you some elements of the model so that you can get a grip of the gist of the model here. I will show you how we get even closer to replicating the equity premia in the two sectors, so we will get very close to it if we change one model assumption. And in my final concluding remarks, I will tell you about some possible extension or additional analysis here for research projects. So this may be perhaps an idea for your PhD thesis paper, and so please take your time to watch the next 15 minutes. Okay, let me go into the description of the model. So one seminal paper here is the paper by German in the Journal of Monetary Economics, 1998. He was able to replicate the equity premium in the aggregate sector in a one sector model by introducing habit formation and installment cost of capital. So we will build on this, on his ideas. In fact, we show you in our book, Dynamic General Equilibrium Modeling, how you can compute the German model here. For this, you need more sophisticated methods, projection methods, so rather than using a simple log linearization of the real business cycle model. In subsequent work, Uhlich and Letter and Uhlich have shown how you can handle endogenous labor, either by wage stickiness or habits, and we use wage stickiness. And one thing that we would like to take up in the third edition of our book on Dynamic General Equilibrium Modeling, which is scheduled for the second half of the year 2022. Well, there we would like also to look at rare disasters, which was introduced by Guriel, so that you have, for example, something like the Great Recession or the world stock market crash in 1929, where you have something like a really, really big disaster, and which may also help you to explain the behavior of risky returns like the one on stocks. And for this kind of models, of course, you need a different numerical method than a local approximation, and it's a little bit more tricky, and we will show you hopefully in our upcoming third edition of the Dynamic General Equilibrium Modeling graduate textbook. Now, what has been less intensively studied is the equity premium in the two-sector model. So far, we only know of a paper by Baldwin, Cristiano, and in the American Economic Review 2001, but they have not analyzed the stock market behavior in this two-sector model. So we take it one step further and introduce adjustment costs so that we have share prices, stock prices, Tobin's Q in our model, and are able to contrast it with our empirical results for these two sectors. Now the model starts from production function of the consumption good CT and investment good IT, which are both stochastic, so total productivity is denoted by Z. ZCT in the consumption sector and ZIT in the investment goods sector, and we just use a constant elasticity of substitution function here for production. Total factor productivity Z follows a trend-stationary process, a unit root process, a random walk with constant drift A and autocorrelated innovations epsilon. So here we capture the essence in this drift parameter AX, that the drift parameter, the growth in productivity, is much larger in the investment sector than in the consumption goods sector. And we also estimate the volatility of the autocorrelated innovations here, our sigma Z. Labor and capital must be allocated to the two sectors, consumption goods, investment goods sector, prior to the realization of the technology shock ZC and ZI. And total labor in the two sectors must be equal, total labor NT must be equal to the sum of labor in the two sectors, similarly for the capital stock K. Now a typical profit maximization here, intertemporal profit maximization, let's say in the consumption sector, is the maximization of discounted profits. And profits are the consumption goods, the sales minus wage cost minus investment costs. Capital adjustment is described by the third equation on this page here, on this slide, and our adjustment cost function is the standard adjustment cost function that you find in the literature here. Now, as I mentioned, labor supply is chosen prior to the realization of the shock, and it's allocated to the two sectors. This is a very important element that you need to introduce if you consider multi-sector model. So if you want to look at many different industries, you need to keep up this assumption that labor is allocated prior to the shock. And this makes sense. For example, you see that there's a shock, let's say, in the investment goods sector. So, for example, we do not have, lithium is getting kind of scarce, and we need, computer chips are kind of in high demand, high price, and it's hard to get them. Well, as a consequence, you cannot instantly reallocate labor to, let's say, the consumption goods sector to do a haircut or prepare a meal. So there are some frictions in the labor market. And as a consequence, the returns in the two sectors cannot equalize too much. And that's a really sensible, reasonable assumption, as we have seen that the returns and the stock price indices in these two sectors behaved quite differently over recent 20 years. And the household maximizes intertemporal consumption, discounted by the factor beta. And here in this equation, you see habits. So last period consumption has an impact on our utility. So it's present consumption minus last period consumption, which affects our utility. 1 over eta is our intertemporal elasticity, which we set equal to 1 logarithmic utility, which is what you empirically, there's a lot of empirical evidence for this value. And here we have this utility from working, and for example, nu 0, we set it so that labor supply is, on average, is about 30% of available time. And the budget constraint of the household is given by the last equation on this slide 12 here. So he receives or she receives income from working in the consumption sector, wage times her labor supply. In the investment goods sector, wage times labor supply in sector I, and dividends from D from the shares in the consumption goods sector and in the investment goods sector. So we hold shares SC in the consumption sector and SI in the investment goods sector. V is the value, the stock price, the value of the shares. Well, and this already closes the main elements of our model, and we need a more global method, non-local method to compute it. And you know these statistics that I presented to you, that we get the magnitude right of 3% here in the two sectors, the annualized equity premia, but we do not get the quantitative difference between the equity premium and the two sectors. We cannot replicate it. So empirically, it's almost 1%, and we get about 0.24%. That's the shortcoming of our model. Now, let me tell you how we can overcome this deficiency. And therefore, I would like to draw your attention to our working paper. The working paper, or former working paper, is published as a CES-IFO working paper, and you can download it from CES-IFO. So just type CES-IFO working papers, our names, or the title Cyclical Asset Returns in the Consumption and Investment Goods Sector, or the number 4364. And in this paper, we do take a look at not a different stationary process, but, as you can see in equation 3.4 here, at an autoregressive process for total factor productivity. And as you may know from your graduate courses in econometrics, or even your bachelor courses in econometrics, it's hard to distinguish a unit root process, where variable is following a random walk, a unit root, and an autoregressive process where our rho is close to 1, let's say 0.98 or 0.99. That's what we will estimate for this parameter here. The power of the test to distinguish these two cases is small, for example, of the augmented Decay-Fuller test. So when we use this assumption for the process of total factor productivity in the individual sectors and estimate our model, well, let me show you the results here for our quarterly asset return statistics. So now, well, this is given now in quarterly values, while the previous slide was in annualized values here. Quarterly value of 0.74 corresponding to 3.9 something annually equity premium in the consumption sector. And as you can see, well, we get close to it, 0.828. And if we look at the equity premium here in the investment goods sector, 0.96 empirically in the US economy, and we get 1.03 in our model. So now when we switch from a different stationary process for total factor productivity to an auto-regressive process, we are able to match the quantitative difference between the equity premia in these two sectors. Let me also point out our results with respect to the correlation with output growth. So empirically, output growth and the stock returns in the consumption goods sector and in the investment goods sector are basically uncorrelated. So if you do a test of statistical significance, it's always the null hypothesis is always accepted that the two are equal to 0. And when we try to replicate this in our model, well, we get small correlations, 0.18 and 0.138 in our model. Well, this seems to be a little bit off, but what we do get right is that there is an autocorrelated structure in the US economy. This autocorrelation can be found with a lag. So stock returns today are positively autocorrelated with output growth in the next quarter. So if we introduce a lead-led structure, we could get very close to these values here that we estimate in our model. To summarize, we replicate the fact that the equity premia in the two sectors are close to 3%, so we are able to somehow solve the equity premium puzzle, that it's hard to replicate equity premium even with a intertemporal elasticity of substitution close to 1. Wonderful. So this is very neat feature of this model. We also get the qualitative element, right? The qualitative observation that the equity premium in the investment goods sector is larger than the consumption goods sector. We do not get the quantitative difference, right, if we assume a different stationary process for total factor productivity. But if we go to an autoregressive process, R1 process, then we are fine and get also then the quantitative magnitudes, right, and also the correlation patterns. In addition, I have not laid this out in detail in this talk here, but we get a lot of other things, right, which we observe on the financial markets and which we provide the empirical facts for, one of the first to do so. For example, we look at sectoral stock returns and the ability of log price dividends to forecast them, and that's the case both empirically and in our model, and we also replicate the weak predictability of the risk-free rate. Now, in conclusion, let me tell you where you can direct your research to if you want to do a research project as a postgraduate, or if you're still looking for a topic for your PhD thesis. What's up to do? What's next? Well, we have looked at two sectors, consumption goods, investment goods sector. But the next step, of course, is further disaggregation and look at multi-industry level here. And go one step closer to what, well, the banking manager is really looking for and where you can make money out of it. I doubt that you can already make money with this one, what we did, but if you disaggregate it further, well, there might be some money to it. Of course, also an interesting research question. Now, you can improve upon the modeling, and there are a couple of elements we think are quite attractive and good candidates for improving this model and pushing it further to replicate what we observe empirically. So I can imagine that we have not looked into it, but that the depreciation rate in the two sectors might behave differently. So we have just assumed it's the same in the consumption goods sector and the investment goods sector. But we have seen that total factor productivity technology is changing at a much higher speed in the investment goods sector than in the consumption goods sector. So it would be natural to assume that depreciation in the investment goods sector is also larger and perhaps more stochastic. And this might be an element, if you introduce it, well, this might help to produce a higher equity premium in the investment goods sector. So far, labor in our model is homogeneous, so it doesn't really matter where it gets applied in the consumption goods sector or in the investment goods sector, and we only have one skill level. But of course, skill levels might be different. So for example, you do not need a university education, you do not need to study our models here to do a haircut or to cook a meal. But if you work in a high-tech firm, have a startup and try to develop some artificial intelligence algorithm or stuff like this, well, you need skills. And if you introduce skilled and unskilled workers in the model, and notice that they might be used differently in the consumption goods and in the investment goods sector. For example, skilled labor might be more complementary to capital. That's what we observe, and there are really nice papers on this. Well, this might generate a higher equity premium in the investment goods sector. Well, and of course, what's always up for further analysis, we might introduce different shocks, preference shocks or tax shock. So for example, we have observed that over recent 20, 30 years, the taxation of labor has gone down in the United States and the taxation of capital has gone up. So of course, this might also impinge on our results here and on our equity premium. Okay, so I hope you enjoyed this presentation, perhaps can even get some ideas for your own research. Please cite our paper. And if you have questions or remarks, please feel free to send me an email. And thank you for your attention.